Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will talk about the trading strategies for the Chinese stock market.
Hello everyone, my name is Radovan Vojtko, I'm CEO of Quantpedia. Today I would like to discuss trading strategies and investing strategies in international markets. So the US, the United States stocks, makes around 50% of world market equity capitalization. So there is another 50% of the market that's not in US. What are those countries? So usually it's European Union, Japan and other developed markets and some of the big names from emerging markets like China or India. We do not cover only US equities or US strategies. So in Quantpedia, there is possible to use the button region to sort for different strategies from different regions. I would like to discuss the Chinese market in this video. So we will speak about the China. China is a really big market at the moment. Investing and trading of stocks is growing in this country. There are a lot of trading strategies, a lot of investment strategies that are working in US that we can translate and use also in China. One of the examples is intraday and overnight seasonalities FX that works very well in US and they works very well in China. So it means the overnight session usually has higher performance than intraday session for a lot of the anomalies and all of the trading strategies. And this works very well in China as well as in US. But we already covered the overnight trading and overnight trading strategies well in other previous videos. So I would like to mention another thing that's very important when you want to invest or trade international stocks, or in this case, China. A very important thing is the impact of dataset selection on the performance of trading strategies. So what does it mean? There are a lot of companies that are listed in the local Chinese market, and also there are other companies listed in other European and Japanese markets that are traded also in the US. They are traded in the form of ADR. ADR is a special form of the stock, so the stock is not traded only on a local market, but it has also a special entity on the US market where you can directly buy the stock without entering the Chinese market. You can very easily check the list of ADRs for each country on publicly available screeners like finviz.com or finance.yahoo.com or other screeners. So here we have here I picked the country China, and as you can see, we have over nearly 200 or 300 stocks that are from China and are available to buy on the US market. Some of the biggest names like Alibaba, Baidu, Tencent, etc. etc. We can buy those names in US market, but what is very important is to understand that not all of the strategies that work very well in local Chinese markets, so in China, works well also in these ADRs or in these stocks that are traded also in the US. There are some strategies that works very well in local market, but they do not work at all in Chinese ADRs or in local exchange. So those are the exchanges that are more easily available for international investors. I will try to show you what does it mean or what I mean by that. So we were able to obtain the dataset from DataS, the dataset that covers the Chinese A-shares, so it's a Chinese local in mainland market, and we try to run strategies developed by academics and compare the performance based on the local Chinese A-share market, mainland market, and compare the performance of trading strategy that's traded using the ADRs, the stocks that can be accessed easily on the US market, and build the stocks of Chinese companies. So the first trading strategy is written by Liu, Qiu, Shen, and Heng in 2022, and it's a long-short reversal portfolio, but there is a condition on arbitrage intensity that's calculated via the variable called co-reversal that measures the degree of abnormal return correlation among the stocks. The calculation is very easy, and we can use only just pricing data calculate this strategy, so it's not hard to calculate. And we performed two backtests. The first backtest was performed on Chinese ADRs listed in US market like New York Stock Exchange, and we can see that performance of this strategy is not very nice. So we have a negative performance, very high drawdown, over 40%. Overall, the strategy is not performing at all on Chinese ADRs in the US. On the other hand, when we try to backtest the performance on the local Chinese A-shares, so in the local mainland market, the performance was positive, so we had a positive performance with a small drawdown. Strategies work well in a local Chinese market. Why is that so? And what is the reason? The probable reason for that is because the Chinese market has some specifics as other emerging market countries or other international countries. So not all of the strategies can be easily translated into the Chinese market or from Chinese market into a Chinese ADR in the US. So it's very important to pay attention what is the data set used and where is the anomaly really present. So there is another paper written by Yun, Huang, Liu, and Sarah. What they found out is the participation of retail investors differs in Chinese markets between the high-priced stocks and low-priced stocks. So the Chinese market is very, very popular in Chinese retail investors. So there is a different number of retail participants compared to institutions in local Chinese market compared to other developed markets like US. The US market is driven mainly by institutions. On the other hand, the Chinese local market is driven mainly by retail investors. And because it's driven by retail investors, there are some strategies that are working better in the local Chinese market. And that's also the reason for the second trading strategy, or that's also the case for the second trading strategy. It shows that the lowest price stocks has a very strong short-term reversal. On the other hand, the high-priced stocks has very strong momentum. And because the ADRs in the US are usually the high-priced stocks and usually the stocks from the bigger companies, reversal strategies are not performing very well in ADRs. They are better performing in a local Chinese market. On the other hand, we can check what is the performance of the momentum methodology or momentum trading strategies in Chinese stocks. So we tried second backtest. Investment universe consists of 400 stocks by market cap, tested on the local A-shares market, so in the local China market. We can see that the momentum strategy based on highest price stocks perform very well or perform as well. So we have over 8% performance in the Chinese local market. And what is the performance when we apply the strategy in ADRs in the United States? So we can see that again the performance of the strategy is significantly lower with the high maximum drawdown. So even that we are using the higher priced stocks and large cap stocks, still the strategy performs well in China, but not in ADRs. What is our conclusion? So it would be great if investment factors and trading strategies worked all around the world without the change and under all circumstances, but it's not like that. It's very important. Some of the strategies are very market specific, as we showed in this short analysis, and especially Chinese market has its own specifics, so high representation of retail investors and there is low efficiency. We cannot count strategies to work the same way as they work in the US. So there is very, very important to pay attention when we have some anomaly. It is possible that it's only working on some local market because the local market has its own specific. Thank you very much for your attention, and I hope that you will join me in another video.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.